Yeah, there are significant differences on the tax implications of a trust and a FIC, and I'll outline some of the key ones. For inheritance tax purposes, the amounts that can be transferred into a trust are limited to the nil rate band, which is currently 325,000, and for a couple, it's 650,000, in order to avoid any immediate inheritance tax liability. Whereas transfers into a FIC are unlimited. Furthermore, the person setting up the trust may be able to control the funds but cannot benefit from them. Otherwise, the gift will fail for inheritance tax purposes. It'll still be in their estate on death. Whereas in a FIC, the founder can retain control and also receive some of the benefits by extracting the profits. For capital gains tax purposes, assets transferred into a trust are treated as disposals at market value by the person setting up the trust. However, usually the gains can be deferred until the sale of the assets, but as mentioned before, the transfer is limited to the nil rate bands or bands. Transfer as assets into a FIC will again be treated as a disposal at market value with usually no reliefs. However, there will be a credit to the director's loan account with the FIC, which can be drawn from the profits tax-free. A FIC is subject to corporation tax on its income and gains, up to a maximum rate of 25%, whereas trusts with trustee discretion are usually subject to higher rates of tax on income and gains. Families can extract the profits from the FIC by way of a dividend or salary, whichever is most tax efficient. In a trust, distributions can be made to beneficiaries either as income or capital. And again, these will be subject to income tax and possibly inheritance tax as well. As Matt says, it's imperative that professional advice is sought at the earliest, as these are complex arrangements and have to be structured carefully and efficiently.